Hi everyone. Let's discuss the topic of sources of finance. A company needs finance to meet different purposes. Finance may be needed for acquiring fixed assets or for meeting day-to-day expenses. An acquisition of fixed asset involves commitment of funds for a long time. On the other hand, finance for meeting day-to-day expenses is required only for a short duration. Financing is needed to start a business and ramp it up to profitability. There are several sources to consider when looking for startup financing. But first, you need to consider how much money you need and when you will need it. And the financial needs of a business will vary according to the type of and size of the business. For example, processing businesses are usually capital intensive, requiring large amounts of capital. Retail businesses usually require less capital. Debt and equity are the two major sources of financing, and government grants to finance certain aspect of a business may be an option. Also, incentives may be available to locate in certain communities or encourage activities in particular industries. A company has to decide the source of finance, which refers to the period for which it is required. And fixed capital and permanent working capital requirements should be met only through long term sources. Then the company can have an uninterrupted use of funds for long period. The most important sources of long-term finance are discussed in this topic. First one, equity financing. The equity shares are most common source of finance. They are also known as ordinary shares and represent the owner's capital in the company. The holders of equity shares are the real owners of the company. And equity shareholders get dividends if the company earns profits. If there are no profits, they will not get any dividend. The equity share capital is not generally redeemed during the lifetime of the company unless the company opts to return it through buyback shares. And equity shareholders take more risk regarding dividend as well as return of capital. And the equity financing, the exchanging a portion of the ownership of the business for a financial investment in the business. The ownership stake resulting from an equity investment allows the investor to share in the company profits. Equity involves a permanent investment in a company and it is not repaid by the company at a later date. The investment should be properly defined in the formally created a business entity. And an equity stake in a company can be in the form of membership units, as in case of any limited liability company, or in the form of common or preferred stock, as in the corporation. And companies may establish different classes of stock to control voting rights among shareholders. Similarly, the companies may use different type of preferred stock. For example, common stockholder and can vote, while preferred stockholders can generally cannot be. But common stockholders are lost in the line of the company's asset in case of default or bankruptcy. And preferred stockholders receive a predetermined dividend before common stockholders receive a dividend. And second thing, personal savings. The first place to look for money in your own savings at equity. And personal resources can include profit sharing or early retirement funds, real estate, equity loans, or cash values, insurance policies, etc. Life insurance policies, a standard feature of many life insurance policies, the owner's ability to borrow against the cash value of the policy. This does not include term insurance because it has no cash value. The money can be used for business needs. It takes about 2 years for a policy to accumulate sufficient cash value for borrowing. You may borrow most of the cash value of the policy. The loan will reduce and the face value of the policy, and in case of death the loan has to be repaid before the beneficiaries of the policy received and payment. And home equity loans. A home equity loan is a loan backed by the value of the equity in your home. In your home is paid for, it can be used to generate funds for the entire value of your home, and it has been existing mortgage. It can be provide funds on different between the value of house and the unpaid mortgage amount. For example, if your house is worth rupees 2,50,000 with an outstanding mortgage of rupees 1,60,000, you have rupees 90,000 in equity, you can use as the collateral for a home equity loan or line of credit. And say somehow equity loans are set up as a revolving credit line from which you can draw the amount needed at any time. The interest on a home equity loan is tax deductible. Friends and relatives. The founders of a startup business may look to private financing sources such as parents or friends. It may be in the form of equity financing in which the friend or relative receives an ownership interest in the business. However, these investments should be made with the same formality that would be used with the outside vendors. And venture capital. Venture capital refers to financing that comes from companies or individuals in the business of investing in privately held businesses. They provide capital to young businesses in exchange for an ownership share of the business, and venture capital firms usually don't want to participate in the initial financing of business unless the company has management with a proven take record. Generally, they prefer to invest in the companies that have received significant equity investment from the founders or already profitable. And venture capital investors also prefer business that have a competitive advantage or a strong value proposition in the form of a patent, a proven demand for the product, or very special idea. They often take a hands-on approach of their investments. And they representation on the board of directors or sometimes hiring of managements. The venture capital investors can provide valuable guidance on the business advice. However, they are looking for substantial returns on their investments, and their objectives may be at cross purposes with those of founders, and they are not they are often focused on short-term gain. The venture capital firms are usually focused on creating an investment portfolio of business with high growth potential, resulting in high rates of returns. And these businesses are often high risk investments. They may look for annual returns of 25 to 30 percentage on their overall investment portfolio, because these are usually high risk business investments. They want investment with the expected return of 50 percentage or more, assuming that some business investments will return 50 percentage or more, while others will fail. It is hoped that the overall portfolio will return 25 to 30 percentage. And angel investors or individual and businesses that are interested in helping small business survive and grow. So their objectives may be more than just focusing on economic returns. Although the angel investors often have somewhat mission focuses, they are still interested in profitability and security for their investment. So they may still make many of the same demands as well as a venture capitalist. Angel investors may be interested in the economic development of a specific geographic area in which they are located. Angel investors may focus on earlier stage financing and smaller financing amounts than venture capitalists. And government grants. Federal and state governments often have financial assistance in the form of grants or tax credits for startup or expanding businesses. And equity offerings. In this situation, the business sells stock directly to the public depending on the circumstances. Equity offering can raise substantial amount of funds. The structure of the offering can take many forms and requires careful oversight by the company's legal representatives. And debentures or bond debentures, financial securities issued by the companies to raise long-term loans from the public. They are generally redeemable after the stipulated period. Debentures carry a fixed rate of interest which is payable periodically, and the debentures to be repaid after the stipulated period, say 5 years or 7 years. It carry a fixed rate of interest. Such interest is payable periodically as per the terms of issues. And in the event of liquidation, debentures holders are to be paid before preference shareholders and equity shareholders. And debentures is generally secured. It may have a specific charge on the asset or a floating charge on the asset of the company. An initial public offering. Initial public offering or used when companies have profitable operations, management stability, and strong demand for their products or services. This generally does not happen until companies have been in business for several years. To get to this point, they usually will raise funds privately one or more times. Warrants are a special type of instrument used for long-term financing. They are usual for startup companies to encourage investment by minimizing downside risk while providing upside potential. For example, warrants can be issued to management in a startup company as part of the reinvestment package. If the current market price of the stock is below the warrant price, the warrant is worthless, because exercising the warrant would be same as buying the stock at a price higher than the current market price. So warrant is left to expire. Generally, it contain a specific date at which they expire if not exercised by the date. Second thing, debt financing. It involves borrowing funds from creditors with the stipulation of repaying the borrowed funds plus interest at a specified future time. For the creditors, the reward for providing the debt financing is the interest on the amount lent to the borrower. The debt financing may be secured or unsecured. Secured debt has collateral, a valuable asset which is the lender can attach satisfy the loan in case of default by the borrower. Conversely, unsecured debt does not have collateral and places the lender in a less secure position related to repayment in case of default. And it may be short term or long term in their repayment schedules. Generally, short term debt is used to finance current activities such as operations, while long term debt is used to finance assets such as buildings and equipment. And founders of startup business may look to provide sources such as family and friends when starting a business. This may be in form of debt capital at low interest rate. However, if you borrow from relatives and friends, it should be done with the same formality as if it is borrowed from commercial lender. This means creating and executing a formal loan document, and that includes amount borrowed, the interest rate, specific repayment terms. It's based on the projected cash flow of the startup business and collateral in case of default. Bank and other commercial lenders or popular sources of business financing. Most lenders require a solid business plan, positive track record, and plenty of collateral. These are usually hard to come by for a startup business. Once the business is underway and profit and loss statements and cash flow budgets and net worth statements are provided, the company may be able to borrow additional funds. Commercial finance companies may be considered when the business is unable to secure financing from other commercial sources. These companies may be more willing to rely on the quality of the collateral to repay the loan and the track record or project projections of your business. If the business does not have substantial personal asset or collateral. A commercial finance company may not be the best place to secure financing. Also, the cost of finance company money is usually higher than other commercial lenders. And government programs like federal, state, and local governments have programs designed to assist the financing of new ventures and small businesses. The assistance is often in the form of government guarantee of the repayment of a loan from conventional lenders. The guarantee provides the lender repayment assurance for a loan to business that may have a limited asset available for collateral. The best known sources are the Small Business Administrations and USDA Rural Developments. Bonds. Bonds may be used to raise financing for specific activity. They are a special type of debt financing because the debt instrument is issued by a company. And bonds are different from other debt financing instruments because the company specifies the interest rate when the company will pay back principal, that means maturity date. Also, the company does not have to make any payments on the principal and may not make any interest payments until the specified maturity date. The price paid for the bond at the time it is issued is called its face value. When a company issues a bond, it guarantees to pay back the principal, that means face value and plus interest. From a financing perspective, issuing a bond offers company the opportunity to access the financing without having to pay it back until it is successfully applied the funds. The risk of the investors is that the company will default or go bankrupt before the maturity date. However, because bonds or a debt instrument, they are ahead of equity holders or company assets. Lease. A lease method of obtaining the use of assets for the business without using debt or equity financing. It is a legal agreement between two parties that specifies the term and conditions for the rental use of tangible resources such as building or equipment. The lease payments are often due annually. The agreement is usually between the company and a leasing or financing organization and not directly between the company and the organization providing the assets. When the lease ends, the asset is returned to the owner, the lease renewed, or the asset is purchased. It may have an advantage because it does not tie up funds from purchasing an asset. It is often compared to purchasing an asset with debt financing, where the debt repayment is spread over the period of years. However, lease payments often come at the beginning of the year, where debt payments come at end of the year. So the businesses may have more time to generate funds for debt payments, although a down payment is usually required at the beginning of loan period. The term loans or borrowings from banks and financial institutions. They are an important source of long-term fund. In India, term loans are provided by financial institutions and banks for financing large expansion, modernization, and diversification projects. Therefore, this method of financing popularly known as project financing. These things are long term and short term finance sources of finance. Thank you.